On January 15th, 2026, something extraordinary happened behind closed doors. At a private banking conference attended only by elite institutional investors, the CEO of one of America's largest banks quietly revealed a number so large it should have shocked the entire country. Not millions, not billions. $6 trillion, not lost, not stolen, not destroyed, but leaving the U.S. banking system by choice within the next 3 years. No panic, no crash, no collapse. Just money walking out, slowly, logically, and permanently, towards something most people still underestimate. For decades, the U.S. banking system has depended on a silent agreement that most people never questioned. You deposit your money, the bank pays you almost nothing. In return, your money feels safe, accessible, and familiar. That arrangement worked, not because it was fair, but because there were no real alternatives. That era is ending. The core problem facing banks today is not fraud, panic, or reckless speculation. It is something far more dangerous: competition driven by math. For the first time in modern history, everyday depositors and massive institutions alike are being offered a fundamentally better option for holding cash, one that pays meaningfully higher yields while remaining liquid and government-backed. Traditional bank deposits still earn close to 0%. At the same time, new digital dollar instruments backed by U.S. Treasury bills are offering 4 to 5% annually. That difference doesn't sound dramatic at first, but across trillions of dollars it becomes overwhelming. It transforms passive money into productive capital. Banks cannot easily respond. Their entire business model depends on cheap deposits. Deposits are the fuel that funds mortgages, business loans, credit cards, and corporate lending. If banks raise deposit rates to compete, their profit margins collapse. If they don't, deposits slowly leave. Either path leads to pressure. What makes this situation uniquely dangerous is the pace. This is not a classic bank run where fear causes people to withdraw funds overnight. Instead, it's a slow, rational migration. 1 or 2% of deposits move this quarter, a few more next quarter. Over time, the outflows compound, and the damage becomes structural rather than temporary. Banks still hold valuable assets, loans, bonds, and securities, but those assets are long-term and illiquid. Deposits, however, can disappear instantly with a few taps on a phone. When that mismatch grows too large, even healthy institutions face serious liquidity stress. This is why warnings from banking executives are growing louder. They are not predicting collapse tomorrow. They are recognizing a system-level shift that undermines the foundation of traditional banking itself. The problem is simple, unavoidable, and irreversible. When people are offered a better product with similar risk and higher reward, money moves. And once that movement begins at scale, the system built on cheap deposits starts to crack. What's happening right now in global finance is not loud. There are no flashing red alerts, no dramatic collapses, no emergency press conferences. And that's exactly why most people are missing it. The most dangerous shifts in history rarely announce themselves. They begin quietly, inside boardrooms, spreadsheets, and portfolio allocation meetings. That's where this story is unfolding. 2 years ago, something subtle but irreversible occurred. Institutions that manage retirement funds, insurance reserves, and endowments were finally given a green light to step into a new financial system, without breaking rules, without regulatory risk, and without reinventing how they operate. Once that happened, curiosity turned into testing. Testing turned into allocation, and allocation turned into momentum. Here's the critical part. This movement is not driven by ideology or speculation. It's driven by efficiency. Institutions do not care about narratives. They care about yield, liquidity, risk, and reliability. And when a new system starts outperforming the old one on all four, loyalty disappears. That's why this shift is so difficult to stop. There's no villain to regulate away, no bubble to pop, no fraud to expose. The system being built is simply better. Faster settlement, higher returns on idle cash, global movement without friction, transparent accounting, programmable money that behaves exactly as designed. Once decision makers see this in action, the next question becomes unavoidable. Why keep trillions locked in structures designed decades ago when modern infrastructure already exists? Banks understand this threat clearly. That's why lobbying efforts are intensifying. That's why regulatory debates are heating up. That's why executives are warning about deposit outflows instead of celebrating innovation. They know what happens when customers are offered superior alternatives. What makes this moment especially powerful is who is building the replacement. Not startups chasing hype, not anonymous developers, but the most established institutions in finance. Firms trusted with the world's largest pools of capital. When those firms move, others follow. Network effects take over, concentration accelerates, and hesitation becomes expensive. This is no longer about whether digital finance works. That question has already been answered. The real question now is timing. How fast does adoption move from institutions to corporations, and from corporations to everyday people? Because once the shift becomes normal instead of novel, the transformation won't feel revolutionary. It will feel obvious. And by then, the system that dominated for a century will already be quietly losing its grip. To understand why the global financial system is quietly shifting beneath our feet, we have to go back to a moment most people barely noticed. For more than 10 years, digital assets existed on the edge of legitimacy. Regulators were cautious, institutions were hesitant, and mainstream finance treated the entire space as experimental at best and dangerous at worst. Applications were delayed, denied, or buried under layers of bureaucracy. The message was clear. This system was not ready. Then something changed. When the world's largest asset managers entered the conversation, the tone shifted overnight. These firms don't chase trends. They build infrastructure. They don't ask for permission unless they are confident the answer will eventually be yes. When they prepared their entry into digital assets, they did it the only way they know how, by aligning completely with regulators, risk managers, and institutional standards. When approval finally arrived, it wasn't symbolic, it was operational. Suddenly, digital assets were no longer held only by early adopters and speculators. They were held by pension funds responsible for teachers and police officers, by endowments funding universities, by insurance companies backing long-term liabilities. These are institutions designed to survive decades, not chase short-term returns. The speed of adoption shocked even seasoned market observers. Capital that normally takes years to deploy flowed in within months. But the most important signal wasn't the volume, it was behavior. Institutions didn't treat digital assets like lottery tickets. They treated them like components of a diversified portfolio. Why? Because the old portfolio model had quietly stopped working. For decades, investors relied on a simple balance: stocks for growth, bonds for stability. Bonds paid enough interest to protect purchasing power and dampen volatility. But after years of near-zero interest rates, that balance broke down. Bonds no longer provided meaningful income. In many cases, they barely kept up with inflation. Institutions needed something else, not a replacement for stocks or bonds, but an asset with different behavior, low correlation, and global liquidity. Digital assets, once stripped of hype and accessed through regulated vehicles, fit that role. The barrier had never been belief. It was access. Holding digital assets directly introduced custody risks, operational complexity, and governance challenges. Once those problems were solved through familiar structures, brokerage accounts, custodians, compliance frameworks, the hesitation disappeared. Here's the truth most people are missing about the banking system. It isn't collapsing because of some dramatic mismanagement or a sudden wave of panic. No, the real story is much quieter, much more powerful, and it's already happening. It's a fundamental shift, a great migration of capital, driven by one simple, undeniable force: yield. Think about your traditional bank account. What kind of interest does it pay? Probably close to zero, right? You might get a little more from treasury bonds, but they're not exactly convenient for your daily spending needs. Now, what if I told you there's an alternative that offers the same level of safety backed by US government securities, but pays you 4 to 5% annually with instant access to your money? This is the new reality of stablecoins and tokenized money. The math is simple and brutal. Why would anyone, from a regular person to a massive corporation, accept almost no return on their cash when they can safely earn 5 times more? This isn't just a theory, it's a financial revolution in motion. We're talking about trillions of dollars here. The big players, state pension funds, university endowments, corporate treasuries, are already moving their capital. They're not panicking. They're making a smart, rational economic choice. The first clue was the massive success of Bitcoin ETFs. That was the market screaming that institutions were hungry for digital assets. Now, the next phase is here: tokenized cash-like instruments. These are the digital dollars that are making the old system obsolete. And once these products became available through the same brokerages these institutions already use, the floodgates opened. Imagine this on a massive scale. Banks make money by taking your deposits and lending them out as long-term loans like mortgages. The problem is, when even a small fraction of those deposits quietly moves to these higher-yielding digital alternatives, the bank's foundation starts to get shaky. They still have all those long-term loans on their books, but their pool of cheap, liquid funding, your deposits, is shrinking. To cover the gap, they have to borrow from other banks, or even the Federal Reserve, but that's expensive. Suddenly, their profit margins get squeezed. Their stock prices start to drop. Credit rating agencies begin to ask tough questions. Let's be clear, this isn't about banks going insolvent overnight. It's a slow, structural change in how money itself moves through the system. And the numbers are staggering. Top banking executives have privately estimated that around $6 trillion are potentially on the move. That's not a typo. $6 trillion. This isn't a bank run fueled by fear. It's a calm, calculated walk towards a better deal. When a better option exists, one with higher yield, more transparency, and greater accessibility, capital will always flow to it. It starts as a trickle, a few billion here, a few billion there, but that trickle grows, compounding month after month until the outflow becomes a torrent. And it's not just about the money, it's about the underlying technology. This new financial infrastructure operates 24/7. Transactions settle instantly, not in days. It integrates seamlessly into the global financial system. A corporation can pay a supplier on the other side of the world in seconds. An individual can start earning meaningful interest on their cash without filling out a single form or opening a new bank account. This technology solves the friction and inefficiency that traditional banking has struggled with for decades. BlackRock's $70 billion Bitcoin ETF was the proof of concept. It showed that the pipes could handle institutional-sized demand. Now, tokenized money markets are proving that these digital rails can operate at an even larger scale. And with federally regulated stablecoins providing the secure on-ramp, trillions more are set to enter this new ecosystem. Once the system is fully in place, traditional bank deposits lose their monopoly. They become just one option among many, and frankly, not the best one. People won't be pulling their money out in a panic. They'll just make quiet, rational, gradual choices to move their funds to where they're treated best. And over time, those individual choices add up to a historic migration of capital. Now, does this mean the end of all banks? Not necessarily. This isn't about completely replacing them. The banks that adapt will survive and even thrive in this new world. They'll become the custodians, the compliance experts, and the infrastructure providers for this digital financial system. But the banks that resist, the ones that cling to the old model, risk becoming irrelevant. And for the first time in a century, the power is shifting back to the customer. We finally have real leverage. Better products, driven by better technology, are winning. Efficiency, yield, and instant access are rewriting the rules of finance. That $6 trillion shift isn't some future prediction, it's already happening. By the time this story makes front-page news, the entire financial system will look fundamentally different. The institutions and the individuals who understand this today will be the ones who control wealth and opportunity tomorrow. The rest will be left on the sidelines, watching the world change before their very eyes. But here's the part most people miss. This story isn't over. In fact, it's a repeating pattern, a loop that's spinning faster than anyone expected. Every major move we see today becomes tomorrow's mainstream trend. The same forces that are pulling billions out of banks and into digital assets at the institutional level will soon cascade down to corporate treasuries, then to everyday investors, and eventually to international capital flows. Just think about it. Once the key ingredients are there, trust in the system, attractive yields, and easy-to-use infrastructure, adoption just naturally accelerates. The first wave, the Bitcoin ETFs, proved the demand existed. The second wave built the operational systems, the tokenized money markets. And the third wave, which is just beginning, is all about spreading access to everyone, everywhere. This cycle feeds on itself. More adoption encourages developers to build more and better infrastructure. Better infrastructure makes it easier for more people to join, which leads to even more adoption. This isn't just wishful thinking. It's the basic math of network effects. It's a force of momentum that can't be stopped by slow-moving regulation or institutional hesitation. So let's break down this loop one more time. You've seen the stories: deposits leaving banks, assets flooding into Bitcoin ETFs, tokenized funds gaining traction, stablecoins offering yields that banks can't match. Each of these events is just one stage in a repeating sequence. First comes the proof of concept, then comes initial adoption by the pioneers, then the infrastructure is built to scale. This leads to an acceleration of growth, and finally, mainstream acceptance. And every time this loop completes, the scale gets bigger. Institutions move first, then corporations follow, and finally, individuals jump in. By the time the average person on the street is talking about it, the shift is already irreversible. So, my advice to you is this. Remember this cycle. Learn to recognize the stages. Keep an eye on adoption curves, on new regulatory approvals, and most importantly, on the yield opportunities. This story is unfolding in real time, but the pattern is predictable. Those who understand that pattern early are the ones who get ahead. This is the loop of modern finance. It's continuous, it's compounding, and it's rewriting everything we thought we knew about money, banking, and opportunity. Thanks for watching, and don't forget to follow for more insights into the future of finance.